Hi, everyone. Lisa Crosta from Crescent Harbor Private Wealth. Today, we're here with the Chief Investment Officer from Sanctuary, Marianne Bartels. You may have seen her on TV, so we're lucky to have her today. Marianne brings a deep perspective to market cycles, investment behavior, and really helps translate complex environments into real-world solutions. So the topic today is clarity in a noisy market, and how can we turn the headlines into smart decisions? So let's start with that topic. Investors are being hit with so much information. I mean, unless you're buried under, a rock somewhere, there's a lot going on. The war, the dollar, the oil prices, a lot of it. So what would you say actually matters the most right now, and what's just noise?
So, what always matters in the direction of stock prices is earnings. And so, although there can be a lot of unsettling things happening, including a war, and significantly higher oil prices, the technology companies, particularly the hyperscalers, right? The people with the data centers,
Right.
are posting mind-boggling earnings, right?
Yeah.
I would say 3 months ago, 6 months ago, we were questioning with all the capex that their capital spending, whether or not all this billions of dollars, like $600 billion, would ever turn into revenue and earnings. And boy, in the first quarter, have they proven that they can post revenues, they can post earnings, and they can expand their profit margins at the same time. And that's what the market is focused on. And that's why we're hitting record all-time highs, even though the environment for the consumer is not good because of the higher oil prices.
Right.
And even though we're at a war, it doesn't matter because earnings are higher.
Right. Right. Yeah, last week, so many earnings came out, right? That was last week, I think. And it was
Yes.
amazing. Is there anything you think investors are overreacting to?
I don't know. I have found when a client, an individual client, is dealing with a financial advisor that has really sat down with them and has educated them about their portfolio and their goals and how they're positioned. I'm amazed when I ask advisors, "Are you getting a lot of calls from clients?" The answer is actually no. And what's really interesting, the data is showing as markets pull back, retail investors are actually buying. So they've learned to actually take advantage of periods within the market where we get pullbacks, which is not what we used to see years ago. So
Right.
that is something really new that we're seeing. And I really have to credit the financial advisors that have educated clients in how to position and how to be patient. I think that's always a key word, to be patient and not hit the panic button when it feels like we're in a panic environment.
Yeah, yeah. And what I talked about with Marianne before, my clients all have a plan. So they don't freak out. They don't call. They have questions, but we don't sell. I don't have one client that sold during this period or Liberation Day last year. And a few clients have called in and said, I have some extra money. Can we put it to work? So thank you for that shout out, Marianne.
You're welcome.
What would you say is the biggest disconnect maybe right now between reality and the headlines?
I mean, to be honest, if I was handed a script, or any professional on Wall Street, including advisors, were
Right.
handed a script saying that we would have a war with Iran, we would have crude oil above 100 for a sustainable period of time,
Hmm.
I would say at least 90% of us, if not higher, would have said we would have had a bear market and stocks would have been down at least 20 or 30%, right?
Right.
With the Strait of Hormuz even closed, right? That has always been the risk in the Middle East. And that didn't happen. We went down like 7%. Now, internally, there were some stocks that did go down 20 or 30%, but the
Right.
market averages only went down 7 to 10. And that was pretty shocking.
Yeah.
Even for me, I feel like I was transported to a different universe with different rules. Like the like the
Yeah.
rules, the rules of the market changed. And it's all because I've always said the market's smart, the market knows what's happening, and it's all because the earnings power of the AI companies is just extraordinary.
Yeah. It's overshadowing these things that might be pulling the market down.
Correct.
I don't, we probably touched it. Is there anything in the market you would say that's not consensus that but investors should be listening to, something, quietly brewing underneath that maybe they're not paying attention to?
Um, Inflation, but I think they're paying attention to inflation.
Yeah.
To be told that we don't have inflation is an insult because we do have inflation, especially now with
Yeah.
gasoline prices above $4.
Yeah.
But we've been arguing that we are in an inflationary environment. We were in a disinflationary environment from 1980 to pretty much 2020.
Yeah. Long time.
And interest rates bottomed, and we're not going to see zero interest rates again. And now I think we're reflating and we're in that inflationary period. But we got to go back to economics to understand that even inflation has long cycles. We have a good cycle of inflation. People may not realize, but we do have a good cycle. Think of the 1950s and part of the 1960s.
Right.
We did have inflation, but we also had a very good stock market and a good economy. And that's exactly where we are today. But the question is starting to brew. Will the Fed not be able to cut rates the way President Trump wants? And in fact, will they have to begin raising rates? I
Right.
think that's what we have to watch because it doesn't matter even if the Fed doesn't raise rates, the market can raise rates for them. Markets
Right.
move before the Fed, believe it or not. And so that's what we have to watch is the direction of interest rates. The market is anticipating inflation to go up because of the higher oil prices over the next couple of months. I've heard some numbers as high as 4% on some of our inflation gauges. And I
Right.
don't think the market will be spooked by that because it already anticipates. This is the other thing. As long as the market knows that's going to happen, it's not a surprise. It's when we get data that's a surprise that the market really has a reaction, whether it's positive or negative. But after we get through a couple of months and get part of these higher oil prices filtered in the data, the question will be, how's the economy doing? Well, the economy right now continues to do well. All our economic data is saying that we're growing very strongly.
Right.
Um, and we just got an employment report today, and
Mhm.
employment is good. In fact, it really is a great environment. It's like Goldilocks. It really,
Yeah.
outside of that gasoline,
Yeah.
we're really in a very good environment for the stock market. Now, even if we continue to have inflation, it's good for equities. Equities are an inflation hedge,
Yeah.
so it's not a reason to sell equities. You can own bonds, but it's a matter of knowing how to manage that bond portfolio. But it doesn't mean that you want to be completely out of fixed income.
Right.
Um, and if we're going to have bad inflation, that is not for another decade or more. I'm not worried about bad inflation today. I'm really making the case that we have good inflation, meaning wages are going up,
Right.
prices of goods are going up, but companies are able to pass that price through, or at least some of it. So that's helping their earnings. Again, it goes back to earnings.
Right.
So the consumer is doing well. Now we have a bifurcated consumer, which we now call the K economy. I don't know who
Mhm.
came up with this, but
Not a great
the
visual, but
up line is the high end consumer, and the down
yeah.
line is the low end consumer. But you feel like maybe that low end is not spending because the line's going down, and that's not true. All consumers are spending. It's just that we're seeing the higher end spend more.
Okay.
And the data is showing, even with higher gasoline prices, that high end continues to increase their spending.
Okay. And the
And
lower end's a little more flat.
well, they're growing,
Uh-huh.
but they're becoming a lot more selective where they're putting their dollars. And we're
Yeah.
hearing that from CEOs like McDonald's,
Yeah.
from the consumer staple companies. That low end consumer, because probably they're spending more on gasoline, is being a lot more selective where they're doing their purchases, or maybe they're not purchasing as much,
Right.
but everybody's purchasing. And since the consumer is 70% of our economy of GDP, um, as long as that high end keeps spending,
Yeah.
we're in good shape.
Right. Right. And this kind of circles back. One of my questions I was going to ask you, as people are approaching retirement, is there a way that they should think about positioning with this market now? We touched a little bit on what's going on with the bonds and how the bonds used to be more, I guess, of a protection than it is currently? You want to talk to that?
Sure. So when you and I came into the business, the rule of thumb was
Right.
the allocation to bonds was 100 minus your age.
Yeah,
So
yeah,
as you got older, you would add more and more bonds. But because of the interest rate environment that we're in, and because people are living longer, I don't think that rule applies anymore.
oh no, we don't either.
Yeah, that rule doesn't apply. There also used to be the theory of the 60-40 portfolio,
Hmm.
60% stocks, 40% bonds. That's not really focused on anymore. And especially in the younger generation. The younger generation doesn't believe that they're going to make money in a 60-40 portfolio.
Right.
They're much more diversified in how they're building out their portfolio, which I think is correct.
Yeah,
Um,
times change.
Now, if I'm correct and down the road we have inflation, it means interest rates go up. That's good for retirement. We
Yeah,
want higher income.
yeah,
You just don't want to take that duration. In other words, you don't want to take the risk going out many years. You'll be able to be
right.
on the shorter end of the curve and you ladder and you keep rolling those bonds and you keep clipping a coupon. So
Yep.
I actually think if my thesis winds up being correct, it's great for retirement.
Yeah, yeah.
Right? Especially in US governments.
Yeah, yeah. And I mean, we're still using bonds. We're just using them a little more, a little differently. And I use them always managed because to me, it's a complex market. And with them moving so much, I like them to be managed and somebody doing it every single day and watching it because that's not what I do. And I have a lot of clients that are, buying houses or the next generation's buying houses. And I have listened to what you said, and I agree that we may have higher interest rates in the next decade. And I'm like, you don't hold out for 3%. We're not going back.
No,
Guys,
no.
you're not going back. If you found the house and you have 6%, it's not a terrible rate. It's not in the teens like it was right back in the 70s. But you can't hold out for those old rates. This is not where we're going to be.
So when my dad bought our house back in the 1960s, his interest rate was 6%. What people have forgotten because we've lived in this low interest
Yeah,
rate environment is the average over history for the long end of the curve is between 5 and 6. That's
right.
actually normal. We're actually normalized.
Yeah,
And if you miss the 2-3%, I'm sorry,
right.
but it ain't the chances of that happening is very slim.
Yeah,
And something bad has to happen for that to happen. I think that's the
right.
thing that you have to realize. Something really bad has to happen to get that interest rate to come back down that low. And then if you do that 6% or 7% and rates do go down, you can refinance.
Right. Of course. Of
And
course.
real estate is another hedge against inflation. And we still have a major housing shortage.
Right.
Right. So certain pockets that grossly inflated, like parts of Florida, we've seen prices come down. But
Hmm.
I live in Nyack and Rockland County. There ain't no prices coming down. We're close to the city. There's no
Yeah,
supply.
yeah,
And what we used to be able to buy for 250,000 is now
yeah,
750,000.
yeah. They keep
And we're
going
not
up.
going back down to 250,000.
No, unless there's a serious problem somewhere
It
else.
has to be something really
Yes.
bad. And we do
Yeah.
not see that happening.
Right. Right. No, that's good. And then tying into what the younger investors are doing, and I wanted to bring up crypto because I know you talk about it. It's really a part of people's portfolios now. So give me a little bit, kind of speaking to those who don't get it and still think it's maybe fake, which we know it's not.
So listen. Anytime there's new technology, people don't like it.
Right.
Example, my mom used an old-fashioned typewriter. She was an executive assistant, she was a typist, and she was darn good at it.
Right.
When the electric typewriter came around, she hated it. That is
Yeah.
right?
Yeah.
Because
Yeah.
she was so
She's
used to
afraid.
the hard keys
Yeah.
that trying to type soft she didn't like.
Right.
There's always part of the generation that doesn't like when new technology gets introduced.
Absolutely.
And just because you don't like it doesn't mean that it's not going to stay and hang around.
Right.
That's where I bucket crypto. Listen, I get it. It's air pudding and wind sauce. It- Now think about that air pudding and wind sauce. There's nothing there.
Nothing there.
It's like Wi-Fi. We know it's there, but we can't touch it.
Right.
Bitcoin is a store of value. It is a mathematical algorithm. It trades 24/7, 365 days a year. Think
Hmm.
of it as artwork. It's
Yeah.
whatever the value that people are willing to put on it, it will trade at.
Okay.
It is considered a scarce value investment because only 21 million Bitcoin will be created. So it's considered scarce.
Right.
Now, a competition to Bitcoin that came is called stablecoin. Stablecoin is a digital US dollar. They are backed by US dollars and they trade electronically. For those that understand, it's on the blockchain. All you need to know about the blockchain, it's a fancy electronic program that's considered safer.
Right.
And we are moving, what we're really doing, what is happening, because we're in the digital era, technology keeps growing and growing and growing. We're moving to a currency world globally that will all be digitized.
Right.
If you go to China right now, you don't see currency. It's all electronic, 100% electronic.
Really? I didn't know that. Okay.
We stopped making pennies. I think we're going to stop making nickels. These are all the early stages of moving to a 100% digital platform. Now, my thesis is you can't go 100% digital until the baby boomers are gone.
Yeah.
Baby boomers are not going to give up hard currency.
Right.
They're just not going to.
Hmm.
But if you talk to a younger person, let's say a person in their 20s,
Yeah.
ask them for cash, the likelihood of them having cash is zero.
Totally.
They don't
Absolutely.
have cash. You have to remember, young people grew up with technology. They're okay with things out in space because it's been out in space their entire life.
Yeah. Yeah.
So now, other cryptocurrencies like Ethereum, Ripple, which is XRP, those are pieces of technology. Those are companies
Right.
creating technology on the blockchain.
Right.
This is considered the next generation of technology. It's also called Web 3.0. So Web 1.0 was the internet. All
Right.
you could do originally was read it. Then you got Web 2.0. You could read, write on the internet. Now we have Web 3. You can read, write, and own on the internet or blockchain, and that's
Right.
Bitcoin.
Yeah, that was a great explanation. No, it's good. I talk to young people sometimes and help them with their first job and just some of the stuff they should know. And and parents sometimes I'm like, in college they should be getting their first credit card. They have to get their credit started. And they shouldn't use debit cards because it's not safe anymore. So everybody's just moved in every way to just, credit and figuring out how to manage it is part of life. It's not reckless anymore. You have to learn how to do it. It has to be part of what you do because that's the way you're going to pay for everything. No one's going to take money anymore. So,
Yeah, that's kind of, and a lot of people will say, but Marianne, we already have credit cards. We have Visa, MasterCard, debit card, but those are cards.
yeah, that's going to go
Having
away.
money
Okay.
on the physical blockchain is very different than a debit card.
Yeah, yeah. And stablecoin's going to it'll be interesting, I think, to watch the stablecoin progression. All right, turning a little bit to just some investor mistakes. We touched on this earlier on, but where are investors, would you say, most likely to get in their own way right now?
Oh, they sell. They
Yeah,
panic and they sell. They hit the panic button.
right.
I have
Right.
seen this countless of times.
Hmm.
And what I try to educate clients is if you're going to do that, then you got to get the second trade right. Let's say you get the sell right. Let's say you get the sell right. You sell and the market still goes down.
Yep.
You have to get the buy right too.
So
And
much
it's
harder.
much harder because markets go down on bad news and they bottom on bad news.
Yeah.
And unless you're a disciplined investor, it is very hard to buy near the bottom or
And
even as it rallies.
it's scarier. It's much easier to sell than to buy. And then people hesitate and they miss, right? That we've all seen those charts. If you miss the top 10 days in the market, you miss so much of the return. And it's
Correct.
very hard to hit that buy button when you have all the cash and you're not sure it's going to go up yet. So no, I
And that just
absolutely agree.
recently happened. When we
Yeah.
were down 7 or 10%, we were up 10% like in 10 days. It was the fastest rally in the history of the market.
Was it the
Even for
fastest?
me, like I'm watching this going, this doesn't make any sense. I've never seen this before. I do. I
Right.
feel like I was transported where the rules have changed.
Well, COVID was a pretty quick recovery too, wasn't it? Within the month,
Yes. But
maybe?
that's because the Fed printed so much money
Yeah.
on its balance sheet.
Yeah.
When you throw money at a problem,
Yeah.
money finds its way into the markets.
Right.
It
Right.
just 100% works that way.
Right. And we talked about some of the things that have changed in the cycle. And you said, having oil up and the markets up is kind of unprecedented.
Yes.
Um, and because of the AI power of these companies making so much money that it's fueling the market, it's
If
helping us.
we didn't have this whole AI thing going on, I do think the markets would have been down 20 or 30%.
Do you? Do you?
Yeah, AI is literally the next level.
Yeah.
This is bigger than the internet. It's bigger than when computers came into the workforce. This
Right.
is bigger than the internet.
Right.
And it's global.
Yeah. And that's actually brings me to my next question. What's going on with the non-US markets? Like yeah, I'll let you, you know what I mean.
So never before, I've been doing this for 40 years.
Right.
Never before in my career have I said buy non-US equities
Hmm.
and hold on to them for a long time. Normally, it's
Wow.
like, okay, we'll own them for a couple of years and then we're going to get out of them. I think we're going to be able to diversify outside of the United States for the next 10 or 15 years.
Both
There,
developed and emerging.
yes.
Yeah.
Now, remember, inflation, commodities going up is very bullish for emerging markets. Now, I'm bullish emerging markets ex China. China has a lot of issues,
Okay.
but ex China, major secular bull market. Japan was in a 35-year secular bear market.
Yeah.
They are in the early stages. Think of the US in 2013.
Yep.
That's where Japan is.
I
Um,
just read an article about Japan. It's fascinating what's going on.
so one of the first things that they did was to get corporate governance. Believe it or not, as old as that country is, they did not have good corporate governance. They did
Okay.
not manage for earnings. And they're doing that today. They didn't have a share buyback program. They now do. In fact, their companies are buying back more shares than US companies are buying
Wow.
back their own shares. They have new government leadership. They have stimulative policies. They're good at manufacturing. And I think they're going to become a major manufacturing hub, not just globally, but in the region of Asia. Asia, among itself, is becoming a major um, international trade zone, whether they're friendly with one another or not.
Okay.
We're seeing big um, private companies like a KKR
Hmm.
invest heavily in companies in Asia. They're looking for capital, and a lot of these companies are private. And to raise money, they're actually coming to US companies asking for capital. So there's capital investment that's happening in these countries as well.
And they're trading amongst themselves. It's not just trade with the US, right?
Correct.
Which is a
Correct.
little different. Before,
Yes,
wasn't it all? Okay.
yes, and that it's becoming a huge trade block. And again, they're trading even if they're enemies.
Yeah.
Frenemies. They're frenemies.
That's good. That's a good lesson. Yeah. Okay, so we want to keep it to a half an hour so people will play the video because we know that's when how long people want it. But I guess the timeless principle still applies. Don't panic, be patient, rebalance, maybe you said like,
Oh, rebalance is very, very important because especially if you have growth stocks, which are these AI companies, because they're moving,
yeah,
they're so rapidly in terms
yeah,
of stock price that they become too big in a portfolio.
right.
That you definitely want to rebalance. And you know that's what your job is, right?
Yeah, yeah,
You know the different portfolios and when they need to be rebalanced between, equity, fixed income, and
right,
anything
right.
else you have in the portfolio. But asset allocation is always the number one
Yep,
best predictor of long-term returns. And
right,
part of that is rebalancing. So yes, you should have a disciplined approach to rebalance, not get
right,
too greedy.
right, right. You can't just wait for that last one, to take off. So yeah, I guess any last statement you want to throw out before we finish up?
So my job is to forecast the stock market.
Okay.
And my dad used to say, Marion, especially when I was young and I went to Wall Street, he says, that's like gambling. And I looked at him and I said, well, it is a form of gambling. I said, but it's an educated form of gambling, right?
Mm-hmm.
It's about
Right,
understanding where to place your bets. It's not like throwing dice. It's like
right.
playing blackjack, right?
Not roulette.
At
Yes,
least there's some rules and,
yes.
and guardrails
Love
that you can
blackjack.
use of
Yes.
where you want to be. And I'm a believer that we're in a secular bull market, meaning even if we get pullbacks of a bear market magnitude of 20, 30%, we're going to
Hmm.
recover and go on to new highs.
Okay.
I think the market is marching towards 10,000 to 13,000.
Wow.
I
Okay.
do think technology, particularly the AI companies, are in the early stages of going into a bubble. We talked a lot about a bubble last year.
Right. Right.
And we're not talking about a bubble anymore, but I do think eventually they will be in a bubble. And eventually bubbles don't last forever.
Right.
So I do think this secular bull market will peak somewhere around 2029, 2030.
End of the
Not to
decade.
panic, but the leadership of the market, the tech leadership will fade away.
Hmm.
And new leadership has already showed itself. It's going to be the non-US equity markets. It's going to
Right.
be small cap.
Hmm.
It's going to be value. What's value? Like energy companies.
Right.
It'll probably be more like your staples, your healthcare
Yep.
type of assets. So, I still think we have a very long runway on AI. And even when you listen to the CEOs of the major companies, they're still saying it's very early innings.
Yeah.
And I do believe that's correct.
Okay.
When you run into a problem is when we've already built all the data centers and everybody's purchased all the chips. In other
Right.
words, you're getting closer and closer to capacity.
Capacity. Yeah.
And
Yeah.
when you get there, that's where things will peak. And
Right.
we're not even close yet. Not even
Right.
close.
Right. So for now, we're saying don't open the statements and don't watch too much news.
Correct. Great
Marianne,
piece of advice.
yeah, I think it came from you. Well, thank you very, very much for your time. It's always so, so insightful. Enjoy the rest of your weekend and thank everyone for watching.